All right, we are back for another Friday financial wrap up with, I hope, well rested Mr. Michael Zuber. Morning.
Absolutely well rested. Absolutely. I had a lot of fun.
I love it. So this is for December the 8th, 2023. I can't believe it feels like Christmas in 2 weeks, right? So
Yeah.
what a crazy, crazy fast flying year. Um, let's get right into it. So let's talk about the Fed. What did you see with the Fed this week? Your thoughts with the Fed?
Well, it really started Friday afternoon last week when Jerome Powell spoke. And really, Jerome was really highlighting that, you know what, we've done a lot. We're going to be data sensitive, really kind of leaning towards we're done. We're at the terminal rate, which obviously we've been talking about. The market's been hungry for the terminal rate. Uh, and then what transpired after that was just really a really wild ride with interest rate and the market, as we'll talk about in a minute. The smart money has really started to make some dramatic calls, and this has been a wild week. I don't remember a week like this in quite a while. So yeah, Jerome Powell last Friday afternoon basically came out and said we're at the terminal rate. We're going to be here a while, right? So he's not talking cut, but just that inkling, I think, was enough to set off the animal spirits, and it's been a wild week.
Very interesting. And when you say that, now you've had a mantra higher for longer, and basically Jerome Powell basically confirmed or validated that basically on one of his talking point.
Oh, absolutely. Jerome Powell is basically saying, yeah, we could be done. Our next move might be higher, but we are not talking about, we're not thinking about, it's not even, it's early to be talking about rate cuts. Um, that doesn't mean the market agrees with them, but that's certainly what Jerome Powell is saying. Yes.
Very interesting. Let's continue. So let's talk about the smart money. I know that we talked about the market, the smart money. What is your thoughts when what does the market expect next? Wall Street, private equities. What do you see is happening with smart money going next?
Well, let's in order to see how dramatic the change was, let's go back to last Monday. So
Okay.
not this Monday, a week ago Monday. The market was expecting 3 rate cuts and for them to start in June.
Yep.
Fast forward to this Monday, the one that just passed. The market now has 5 or 6 rate cuts starting as early as March.
Interesting.
So the market is definitely calling BS. The market senses a recession. The market senses that the Fed will stay too high for too long, and they'll have to, I mean, they'll have to cut pretty dramatically. That's what the market is saying.
And so smart money, the market, and again, when we say the market, we're talking about smart money,
Mm-hmm.
bonds, private
Yep.
equity, or public equity, stock
Yep.
markets, all of the above. Is that pretty accurate?
Yeah. I mean, at the end of the day, um, the Fed funds rate, which again they're now not saying 3, they're saying 6 rate cuts. That's really an input to a lot of valuations because that is the starting of risk free. That's the risk free rate of return. So if they expect that to go lower, they can change all of their calculations. So yeah, the smart money is saying the Fed's going to be cutting and cutting big and cutting soon. That's what the smart money is saying.
Interesting. So let's continue. I want to continue and talk about. So we'll transition. I have a question for you, but I think I'll save it for the end and wrapping up because
Mm-hmm.
this is a big deal. This is a really big deal where we're at in this mid early December. Let's
Yes.
talk about what happened with 30-year mortgage rates. Obviously, we saw the rates shift. They're coming down. They're softening. What is your thoughts there? What's going on?
Well, it's really good. So it's funny. While I was, I think right before I left, I made a call that I thought mortgage rates had peaked at
Yep.
803 or 807 or whatever they were, right where they were in the high sevens. And little did I know, in the course of 3 weeks, they would fall 100 basis points.
Yep.
100 basis points. I just got done talking with a mortgage lender. It's no secret. It's Convoy Home Loans. They're on my channel. They told me, you're not going to believe this. FHA buyer, 25% down, perfect credit, so 780 or above, owner OC, 2 points, Just take a wild ass guess what the interest rate, 30-year mortgage they quoted. Just take a wild guess.
It's got a 6 on it. I know. I'm going to guess 6.5, 6.75, somewhere in the mid sixes.
Not even close. 5.25.
What? With 2 points. So wild. So if they buy down the rate, how much?
5.25. So again, if you're this is wild. This is why with this no inventory, if we stay here, this could get. I mean, this could get. Think about that. 5.25. We were just at 8.
Yeah.
Yeah. Wow. Again, 780 credit, 25% down, owner occ, FHA, 5.25. Conventional, 5.6.
Wow. Wild. Absolutely wild. Absolutely wild. I know that on Monday we did a call, the hub call in with Matt, the mortgage guy. Yeah. He had talked about quoting. He had deals that he had quoted, again, good, strong credit. Yeah. It just with not 2 points, but just
6.5. Yeah. 0. Yeah. No points. They call it par, at par, 6.5.
Yeah. Wild.
Wild.
Absolutely.
What do you think that does to housing, folks? What do you think? What do you think that does to housing?
It's interesting. We're gonna talk about inventory and where we think it actually, how it really truly affects housing, what's going to happen in the first quarter. We're going to tie it all together at the very end, state of the very end. Let's continue now. The job market. This is a big week for job market reports, and I want to disclose today we are actually recording this on Thursday. So this is being recorded Thursday, December the 7th, not Friday the 8th. What did you see with the initial job reports? And then let's talk about what's going to happen tomorrow.
Yeah. So this week has been every week in a month, there's 1 month that kind of highlights the job market, and that's this week. There are always 3 reports that come out in series that let us know, is the job market getting strong? Is it weakening? What is going on? On Tuesday, we got the JOLTS report. On Wednesday, we got ADP. And on Friday, tomorrow, we will get the creme de la creme, the Economic Bureau of Labor Statistics, the job market, how many jobs were created. So let's walk through these. On Tuesday, the JOLTS report. What is it? It's essentially a report that shows job openings, quits, all of those things. But it's really the job openings. For the longest time, the JOLTS report was basically a 2-to-1 ratio. 2 job openings for every potential applicant. And we had over 10 million openings. This month, it was expected to be 9.5 million. Last month was 9.6. So it was expected to come in a little bit. It came in a lot of bit. It came in down to 8.7. So a huge miss to the downside. Why is that important? Again, the job market is always the last thing to crumble in a recession. Job openings are the easiest thing to whack if you're going to consolidate or shrink. Like I was an executive at several companies in a recession, and the first thing we did is we closed headcount. That was a big number, 600,000 missed to the downside. So that was a JOLTS report. And that was Tuesday was a huge move in interest rates. Because again, the market, the smart money is looking for validation. And to them, the job market is the last thing holding back no recession. Sort of like Tuesday, job market's weakening. Okay, we're right. A recession's coming. The Fed's going to have to cut. Okay, great. Wednesday, ADP, it's private payrolls. Again, the expectation, I think, was something like 150 job creation. It came in weak, came in at like 116. Not only did it come in weak, but it came in weak for wages. The only thing that's been strong all year was leisure and hospitality. It came in weak with a negative number. So again, the ADP report. Now on Friday, tomorrow, we will get the jobs number. Wish we were recording this Friday. Our schedules didn't work out, so it's okay. But they're expecting 180. If we get a weak number, bingo bango, the market's going to be like, see, I told you the Fed is wrong. They're going to have to cut early. Job market is crashing. That's what the market will say. However, I want to be very clear. Friday's number could be messy because something that happened last month is we had 2 rather large strikes resolve, right? We had the auto workers and Hollywood, right? Actors and screenwriters. Yeah. That's going to potentially really mess up the number. And I think it's going to take a second look behind the scenes. So we'll see. But right now, as of Tuesday and Wednesday, the Fed is happy because the job market is weakening, but not crashing. Right? ADP report wasn't negative, like we
Right.
lost jobs. We just created less. So it's going to be really the job number tomorrow. It could be further validation that the job market is weakening and rates crash, or it could be a surprise to the upside. We won't know until 5:30 a.m. Pacific, so we'll find out.
Very interesting. Wow. And it's interesting that, we're in such a like a roller coaster, right? I mean, every week it feels like, what's going to happen next. And so, when rates were 8%, it felt like we were going to 10%. And
Mhm.
now, now you're talking about 5.5, 6.5% rates.
Right.
Obviously, things are moving. So it's pretty wild.
Yeah, pretty wild. It's pretty wild, is right. It's uh, you know we're going to talk about this next, but last or this year, February and March is when rates fell and demand picked up. What if demand picks up in December and January?
Yeah. Yeah.
Boy,
It's an interesting time for sure. Let's continue. Let's move forward. So we have a mutual friend, Adrian, down in Orange County, Southern California. He's in the Inland Empire as well as really strong in Orange County, parts of LA. I know that you guys had a conversation. You guys do obviously another show. What happened? Talk about the deal and give us that example of a property. Tell that story.
yeah. So here's the deal, right? So again, winter months really slow. We were just at 8% mortgage rates. Demand fell off a cliff. Adrian had a listing that had been on the market for 40 days. On Friday, he was contemplating a six-figure price cut because he wanted to move the property. By Monday afternoon, because rates fell, because social media went wild over the weekend about rates falling, he had three, three full price offers without doing the price drop. Rates
Yep.
matter. People want a deal. Um, People are looking at older listings like I've been talking about for a while. I've heard from three or four different agents since I brought up Adrian's story about their buyers negotiating with a seller, getting into, seemingly getting into contract, but then the dreaded multiple counters.
Yep.
Rates going from 8 to sub 6 matter. That's 200 basis points. That's real payment reduction.
Yeah.
It's Rates matter, man. Rates matter. And if we have no supply and demand comes flying off the sidelines, I don't know what to tell you.
I, this is a this is why I'm so glad that we're connected. And not only that, but in perfect timing, because I feel like we're probably somewhere close to 18 to 24 months in us doing this show together.
Yeah.
But man, I am so happy that I'm connected to you and listening to daily financial news and a part of what you're doing. Let's pull this all together. I know we're going to talk about CPI right now, and then we're going to tie it all together and say, okay, what's going to happen in 2024? But before we do that, CPI is next week.
Yeah.
What should we anticipate? What do you see?
Well, the market, remember what the smart money is saying. The smart money is saying the Fed is winning. So what does that mean, right? So that means that inflation, the CPI headline and core come down next week, which looks like it will. Shelter's rolling over, oil's down, gas is down. So there's a chance. I think CPI last time was like 3.2. It might have been 3.3. There's a chance headline goes to 3. If it breaks 3 and goes to 2.9, watch out. Right? Watch out. Because again, the smart money wants the Fed to be winning. Job market is slowing down, not crashing. Inflation is falling, not going back up. And if all those things start to happen, you could see the 10-year continue to fall. You could see the 10-year sub 4%. Think
Wow.
about that. It was just 5%, a heartbeat ago.
So sub 4. I mean, so this week, where was the 10-year?
Well, the 10-year right now is at 4.15.
And to give like an example, 8 weeks ago, it was
5.03.
okay. Wild. Okay. And so now, I mean, if we see that a sub 4 on the 10-year, that means mortgage rates would probably be in the fives at
Well,
par.
again, at par, it'll be in the sixes.
In the
At par,
sixes.
it'll be in the sixes.
Okay.
But yeah, a couple of points gets everybody into the fives.
Buy down. Yeah. Wild. So wild. So wild. So let's pull it all together. Let's talk about, okay. So the Fed, right? Fed talk, smart money this week, jobs reports, obviously a big anticipation for Friday, CPI next week. What do you see in housing? What do you see in rates? And where is the opportunity for the one rental at a time community?
So we'll start with the last first. We're still in the winter months. I am actually considering a 4-package deal today, right? There, Adam at the Hub has found a 4-package deal that we might be able to put together for $600K. That has a $1 million or more ARV, just rough numbers. So we're fishing, right? We're looking for old listings. We're looking for ugly ducklings. If you're going to buy something today, it can't pass FHA inspection. Because if it's FHA ready, I just shared earlier, they can get a 5%, 5.25% mortgage with the right credit and the right down. So we got to buy ugly ducklings. We got to buy the well used. You can still get those deals done. I don't know if the deal will happen. We're actually doing diligence now. But if you're a one rental at a time, fish, old listings, lot of days on market, not a perfect property. Don't miss this opportunity. Second, where do we go from here?
Yep.
I stand by what I've said pretty much all year. Interest rates in the sixes, and heaven forbid below 6, brings demand. It does nothing to bring supply. And if demand goes up and supply stays stagnant, you tell me what happens to housing. We could be repeating February, March, and April. It could get wild again. And the last thing I'll say is the consumer is predictable. Consumers want a deal. And trust me, a 5.25% mortgage is perceived as a deal when rates were just 8%. It's that simple, folks. It's that simple.
It so strong. I love it. Let me follow up. Do you see that the direction of the market, obviously, do you see that it'll loosen up inventory? Do you feel like it'll loosen up inventory, or we're again probably in this range where across the board, everybody I talk to says their MLS is down 30, 40%, 30, let's call it a third, 33% across the board is the average. I talked to a guy today, his business was cut in half, like an agent from Southern California, somebody that I'm acquainted with. It was cut in half this year. And he's saying, what do I do next? You know, how do I get it back up to par? So do you see this transaction volume level staying about the same into 24?
No. So we just posted 3.8. Or 3.79 to be specific. I called 3.8. Sorry, I missed that. It came in at 3.79. I don't see us getting
when
much.
you call 3.8, when you called 3.8, that was aggressive because, and I want to note for the show, for the viewers, if you don't know, the Redfin CEO said we were at the bottom when we hit right around 4 million.
Correct.
And Michael was contrary, saying, no, we have not hit a bottom. We're in the trough. But you thought 3.8, and 3.8 sounded like a pretty crazy number when you said it. So
yeah, it did.
I just want to give you credit.
Yeah, we got that one right. I think next year we're at 4.2. I think 3.8 is the bottom. I think we'll do 4.2. What I would tell an agent today whose business is half what you were in 21 or 22, it's the new normal. You could play for a 10% upside, because the only thing, if you can get back to 2020, what are you going to, there's got to be a lot of agents that leave. You just need to right size the business for 4.2. And that's hard. Nobody likes it. You got to get rid of your 4th BMW. I'm sorry. I don't know what to tell you. I think we're going to be, I don't think we're above 4.5 million existing sales. I don't think we're there in 2026.
Okay. Makes sense. So folks, realtors, you might want to sell your boat because you'll probably be working a lot and not have
Yeah.
time to go out in the boat in
Yes.
2024.
And if you
So
can, just rent the damn thing. It's a lot cheaper.
it's a lot cheaper. Or go on a friend and pay for the gas.
Yeah,
There you go.
exactly. Use a
There
friend's
you go.
boat, pay for the
There we
gas.
go. I love it. Any parting words for this week, Michael?
No, I'll just close with this. The Las Vegas event that you are gracious enough to come out to is sold out, sold out, sold out. But we are hosting a virtual event for $99. And my intention is to give you the recording after, because I got to tell you, there's no chance in heck I would sit through 20 hours of a video, but I will definitely attend for the sessions I want. And then I will watch the others after the fact. So for $99, you can watch 2 full days, you can interact with us, and you will get the recording. So we are doing that for folks.
I love it. And they can go to onerentalatatime.com to buy that. And they can buy that right now. It's up and live.
It's up and live right now. Yep.
Got it. $99, folks. Do not miss out. This is all of Michael's hitters, all of his experts, his millionaires, everybody. This is going to be epic. And I want to say that, folks, if you like the content here, please subscribe, like, and follow on YouTube. Michael, thank you for all that you do. Have a great weekend.
Thank you, buddy. Appreciate you.